And tech has taken a little bit of a peel back today, which I'm suggesting may be a good thing, that we're having take a little break and see these laggards start to get a little something going.
It's making me feel good, Scott. I mean, you know, I'm long the cyclical trade. I'm overweight the cyclical trade, so I'm enjoying this. I do think it's overdue. I want to be clear, though. I don't think this is a situation, nor from the beginning of the year have I said it's a situation where tech is fundamentally damaged. But at the moment, I do think it's ahead of itself. It's dragged the market higher with it, which is a good thing. But you're seeing the broadening out right now. Here's the most positive thing I can say. When you think about these sectors that have lagged, like energy, like materials, like financials, there's actually fundamental reason to be long these sectors going forward. The earnings have been coming in better than expected, albeit early in the season. But economic activity, which should promote the profit growth for these sectors going forward, is really quite strong. It's what I've been saying all along. I'm not changing my tune, even as I do some trimming on the margin of some positions. I really do think that value is poised from this position to return better than tech, both because of where the price action has been, mainly they've been laggards, and also because of where I see earnings growth going forward.
You feeling good about that Goldman Sachs sale? It's up near 3% today. Financials have just gotten going.
Yep.
Too.
Well,
and now you're a seller of Sherwin-Williams.
Yep.
Still thinking the market's going to pull back.
Yeah, and well, but let's also put this into perspective in terms of size. What I said, and I said this to you yesterday, Scott, I do think at any point in time you can have a 5 to 7% pullback. Now, the market, by the way, could go up 15 to 20% before that happens. And what that means is when you do a little trimming, as I'm doing in the portfolio, you do not get carried away. I'm about 7% cash right now. I'm not going higher than 10%. That's way too much. If I'm wrong in the market rallies, the other 93% that's invested right now will do just fine. To the question that may be on people's minds, well, wait a second, if you're long all these cyclicals, why are you trimming a material stock like Sherwin-Williams or a financial like Goldman Sachs?
Good question. Good questions, viewers.
You know, I've worked with you for 10 years, Scott. I feel a symbiosis here. I've got so much in these cyclicals. I mean, I'm really overweight, and being underweight technology has hurt me. I want to add to technology when it comes down, if it continues to come down. This is not a spot that I want to trim. I've got a very strong overweighting the cyclicals, so that's where I've got to take.
So, Josh, how do we view this idea of growth versus value in this debate perhaps being back? If you look at the 1 month performance, let's say, of the major averages, everything's in lockstep. The NASDAQ over a 1 month period of time up 3.8, 3.9, the Dow up 3.8, and the S&P up 3.7. Today, the Dow, and this week, by the way, over a 1 week period, the Dow is up 2.75% versus somewhat muted gains for the others.
One of the things that we were talking about this spring when we were saying, okay, this is a nice rally, but is this sustainable? Like, can we persist and get back to the old highs, or dare I say get through? And the question was, well, I don't know. Can we do that with 7 stocks, or are we going to have a catch-up trade in the rest of the market? Or it could have gone the other way. You could have had the rest of the market stay stagnant and have these giant growth stocks eventually succumb and catch down. I think we know how that story ended. We've gotten the strength of the rest of the market, and you've got an advanced decline line now for the S&P 500 that is the best since August of 2022. Today, though, is back in the day we used to call this a upside down day. So upside down day is like your biggest losing stocks were the big winners, and your big winners took a breather. Or some people would call it counter trend. That's what you're looking at right now. Out of the top 20 performing stocks in the S&P 500 year to date, 18 out of 20 are down today. And they're not down a little. They're down an average of 2%. So that's an upside down day. I wouldn't use that. I know we're doing a segment, but I wouldn't use that to concoct a whole new narrative about all of a sudden the leadership for the rest of the year is going to switch. It could. But one day is one day. So you got nice outperformance out of healthcare today. These stocks have done